Hey everyone, my name is Kaushal Mohan, and I lead a couple of different product lines here at Idify. I lead the entire API suite of products at Idify, as well as our overall onboarding product, right? So today I will talk about how lenders can predict the probability of fraud using AI and ML, and I will specifically keep an eye out on how to lend to businesses or SMBs. So that will be the focus area of today's conversation. Now, before I get there itself, I do want to spend a couple of minutes grossly oversimplifying RBI's master directions, right, for merchant onboarding. I am only going to be covering a sliver of what the regulations say, of course, and therefore I will not cover, or we don't have the time to cover all of the regulations and all of the different frauds that exist. But I do want to give some context before I jump into a video of how to prevent these frauds. So on an overly simplistic level, a regulated entity broadly needs to, one, to onboard a merchant, collect a specific set of documents as part of proof of business or proof of activity. These are obviously different for different entity types, for sole proprietorships, for partnerships, for corporations, etc., etc. You would have completely different document sets that you are collecting as part of the onboarding process. That's one thing that you need to keep in mind. The second thing is you as an RE need to confirm the nature of business activity, and that has to be verified from the address of the firm. Basically, what the RBI is just saying is that the RE needs to be satisfied that the merchant's nature of business is whatever they are claiming, right? So the RE needs to be satisfied about that. And the third element I want to talk about is that RBI says the RE needs to have a risk-based approach that classifies the customer or the merchant as a high, medium, or low risk merchant. Now, as part of the master guidelines, some suggestions or guidelines have also been provided on how to do this. But they are honestly, again, just suggestions. That's what they are, right? Now, because I'm talking about these three, I do want to call out that all these three spaces are avenues for fraudsters. There are spaces within each of these elements where a fraudster can put a step in. And again, I am reminding you, I'm only covering a sliver of what the regulations say and what frauds happen. So let's look at these one by one, right? You're collecting a specific set of documents as proof of business. Doing that can lead to fraudulent documents. They can lead to tampered documents being provided by the merchant. So you have some form of tampering fraud over there, right? The second thing is you are confirming the nature of business activity. In most cases, it is a self-declaration. That's a generally accepted practice. Now, if it is a self-declaration or if it's an RM-assisted journey where there's a relationship manager who goes and performs this journey on behalf of the customer, then there can either be a collusion fraud, there can be a nature of business fraud, there can be a location fraud. So the merchant is attempting to spoof their location or attempting to spoof their business nature, right? So that's basically what can happen when you are doing a self-declaration on your nature of business activity. Now, in terms of the third thing, one of the suggestions provided by RBI is that risk categorization, one parameter can be nature of business, right? RBI says to do a risk categorization based on XYZ parameters. One of those parameters is nature of business, and that leads itself perfectly into the merchant again trying to categorize themselves as a low risk business. So again, you can basically have a nature of business fraud over here. Now, because these are the regulations and because there are frauds that can come through, what I am going to do is that many of these frauds can actually be instantly detected at the point of onboarding itself via AIML. I think in the previous session, one of the panelists was talking about how if you actually have the right set of checks during your onboarding and underwriting phases, about 60-70% of all of your frauds can be caught. That's basically what I'm going to show you now. So in this video, I'm just going to be playing a video out now. In this video, you will basically see a situation where a fraudster is attempting to spoof the system with fraudulent store images, with fraudulent locations, and so on. And this is broadly how it can actually be blocked.
Kaushal, if it has sound, we are not able to hear. Just trying to.
You're not able to hear the sound. It's okay. I mean, the sound is not very relevant. So basically here, what is actually happening is that the self-declaration of the store has been taken. And with the image of the store, we have run an automated MCC prediction where we can then call out the fraudster saying that, hey, looks like your self-declared nature of business is not the same as the store image. So now the fraudster knows, okay, cool, these guys know how to catch the nature of business. So let me try something else. So the fraudster again declares their nature of business as, let's say, a miscellaneous auto dealer. They're uploading their document again. They're uploading their GST document. And this time, what the fraudster is doing is he's actually taking a picture of some store which is matching his nature of business. So he's taken a picture of Imtiaz Auto Garage, which matches the right nature of business. But here, the fraudster gets blocked because the location of the photo is not matching the address on the document. So broadly, what you saw in this video, and I'll just take a 30 seconds to summarize this, is you can actually use advanced ML algorithms. And again, a very small sliver of the regulations and the frauds is covered in this video, but you can use advanced ML algorithms to do elements which were previously being done manually, right? Which is things like with ML, you can automatically predict the merchant category of a specific merchant or of a specific store. And therefore, you can move away from self-declarations for nature of business. By moving away from self-declarations, you automatically can, move away from nature of business frauds itself. You can then digitize verified documents against government databases. I think this also got called out in the previous session, which is that there are a number of APIs which can digitize data, OCR data from documents, validate them against the government databases. So you do all of those to validate that fraudulent documents are not being used. You can also run tampering checks, forgery checks, Photoshop checks on these documents to validate that these fraudulent documents are not being used by the merchant at the point of onboarding. And lastly, you can also automatically perform, say, an address triangulation, right? By fetching the lat long of the merchant, comparing it against the address that's present on your business document, maybe on your GST, maybe on your, let's say, FSI document, whichever document you are actually using. You can perform this triangulation again in real time. Now, by doing all of this in real time, you are truly blocking a fraudster through these three different mechanisms. And of course, there are many other mechanisms through which you can use ML to block fraudsters, but these are, say, three simple mechanisms, right, at the point of onboarding. Now that I have talked about, say, how you can block fraudsters at the point of onboarding, I will quickly move to a different element of ML being used at the underwriting stage instead of on the onboarding stage, right? In the last 5 minutes, I talked about, say, easy ways to prevent a fraudster from onboarding onto your system. But then there are so many other non-traditional risk signals that do exist. So let's look at legal histories. We'll look at business identity risks, credit income, operational risks, and how to put all of this together, again, via ML. So I'll start with legal history, right? Imagine you are a lender. Let's assume you're a lender. You have lent to a borrower and this borrower is defaulting. Now, when it comes to a bad loan, a lender mostly has three avenues to recover their money. There's the SARFAESI Act, you have your NCLT, you have your DRT. And for this example, I'll just focus on the DRT. For everyone's context who may not be aware, the DRT itself is a special court. It has jurisdiction on loans over 20 lakhs. They can basically sell the borrower's property, auction the borrower's assets, etc., etc. Right? So proceedings in the DRT often end up dragging on for years and years. So it's a time-consuming process. It's a expensive process. Lenders don't want to go this route unless they have no other option. Now, imagine you're a lender, you have lent to a borrower who is defaulting. We had a hunch, and the hunch was that the legal history of an entity can be a leading indicator to a loan default itself. The hunch is basically that someone who has defaulted in the past is likely to default in the future again, right? Somebody who's defrauded a user in the past or defrauded a lender in the past is likely to defraud a lender in the future again. right? This is the fundamental reason why lenders do credit checks. The credit check concept also is very similar, right? You look at the financial history of the individual or of the merchant. But credit scores, of course, are limited to tracking behavior of the borrower with banks and NBFCs. So a few other avenues goes unnoticed. So now let's look at this hunch again. Hunch was that legal history is a leading indicator of probability of loan default. We randomly picked up 5,000 cases from the DRT. So we randomly looked at a set of 5,000 cases in the debt recovery tribunal. And we identified that 90% of companies, 90% who had defaulted on their loans already had court cases even before they entered the DRT list. So basically, these companies which have gotten into the DRT list already had cases against them in the past. So they had defaulted in the past as well. This led to some kind of a validation of our hunch. It led to the conclusion on our end that there is a very strong correlation between, say, the probability of fraud and legal history of the entity. I see that there is a question. I'll just take that at the end. Now, I'll just drive you through a case study, right? So what you see on my screen is a newspaper clipping. This is a clipping for the auction of assets of a certain borrower. This borrower is MS Marketing Enterprises. They had borrowed 13 crores from ICICI Bank. They had borrowed 19 crores from IDFC First, and so on. Now, we looked up MS Marketing and we identified that this default of 30 crores could actually have been prevented if the legal history had been checked prior to lending itself. Why are we saying this? We are basically saying this because MS Marketing themselves actually had 2 prior cases in the DRT. They had 11 check bounce cases. They had 2 criminal cases. They had a number of different cases against them. The 11 check bounce cases alone is quite an indication of lack of intent to pay when it comes to both an individual as well as to a merchant. A check bounce is an important indicator that you can possibly look at. And again, brings me back to my earlier point, which is that legal history is very strongly correlated to probability of fraud. Now, I'm just going to jump from legal history to business and identity checks. Again, fully publicly available information. The legal history is also publicly available. This business identity checks also that I'm going to talk about now, publicly available information, right? You can check the MCA to validate if a company is legit or a merchant is legit. You can check the number of active GSTs that a specific merchant has against their PAN card. These are all APIs that are available. You can check the histories and identities of every single director associated with the company to see if they have any kind of a dubious past. No single parameter will obviously give you, enough to block or onboard a customer, but all these parameters can feed into your risk model. All these parameters can feed into your underlying algorithms to create some form of a risk score. Now, back to MS Marketing, what you can see on my screen is that for MS Marketing themselves, there was actually no active GST found on the PAN card belonging to MS Marketing, which means that they may have just onboarded themselves with a different set of documents and so on. So there are a certain set of business identity checks that you can run as well. Next, I'm not going to spend too much time on credit and income checks because they're widely used by lenders anyway. Credit checks are often the first thing that most lenders do as part of the underwriting process. But MS Marketing themselves, again, had low year-on-year growth. There was a poor debt to EBITDA ratio. And again, these are elements that can broadly be codified within some form of a risk model, right? Lastly, I'm going to look at some hygiene factors. Now, is the company paying PF to all of their employees on time? This is a basic operational check that you can run, right? A company that is defaulting on their PF is a strong indicator of poor standing of the company. For MS, there was no problem. They were actually paying PF month on month. But broadly, the point I do want to drive home is that there are a number of non-conventional risk signals or risk indicators that any lender can consider at the underwriting stage, while there are a number of other elements that the lender can also take care of at the onboarding stage to ensure that you really truly do decrease the probability of future fraud on your books, right? Quickly putting all of this together, I've talked about legal checks, I've talked about business identity, credit income, operational checks, and so on. all of this is publicly available information, right? Every single one of this that I've talked about is actually publicly available, but putting things together becomes difficult. Data is not centralized. One of the biggest reasons why where ML comes in is data is not centralized. You can't parse through all of these 19, 20,000 courts, AML databases, police records, etc., etc. Can't parse through all of those manually. Data in itself is unstructured. Like I'll talk about legal history, for instance. You actually get court cases in different regional languages. Names mismatch across all of the different documents. My name is Kaushal M in one document, Kaushal Mohan in another document. I have different data across different documents. And the data comes in different formats. And of course, makes it very difficult for me to create any kind of inference across all of these data points. This is broadly, where ML in itself comes to the rescue. I think putting all this together to create a single risk report makes the life of a lender significantly simpler. And coming back to, MS Marketing themselves didn't have an active GST, didn't have, let's say, they had some poor financial health. Legal history was not, legal history checks were not really green from the perspective of the set of records the court checks against them. So it was obvious that it was super risky lending to them. And these leading indicators often get missed by traditional underwriting processes. A lot of banks and NBFCs are now, of course, adopting significantly more complex processes. But the point I do want to drive home is it is never truly enough to look at only one or two risk indicators. You'll have to look at, say, 10, 15 different risk indicators, put all of those together in a underlying model to actually predict probability of fraud during the underwriting process. While at the onboarding process in itself, there are elements like MCC prediction, there are elements like address triangulation, there are elements like identifying of different database verifications that you can actually look at when you are onboarding a customer. Broadly, I think that's what I wanted to cover. Happy to get on individual calls and demos with anyone who's interested, but I think we have a couple of minutes for some questions as well. Vikrant, do we have a couple of minutes?
I think we can pick up a few questions. There are some hand raised. Maybe you can pick up.
Can you share your contact details, please?
Sorry?
Can you share your contact details?
Absolutely. I will just drop my contact details in the chat. Right, but I will basically what I'm going to do is I'm just going to put a link in the chat which will help if any of you are interested in a demo or any further details, you can fill up your contact details on the link and we'll get back to you. I will also put in my own contact details on this chat, so you can drop me a WhatsApp if there's anything that you want to specifically talk about from what I have shown you today.